Welcome to ProPEllant, the podcast for private equity operating partners and the founders and CEOs they back. Today's guest is Tony Rock, founder of Lever6 Capital. Tony spent more than 30 years as a founder, operator, and investor, including time as a PE principal and a fractional COO and CFO. He's served over 100 companies and worked nearly $2 billion in deals. Today, we're talking about how to build exit value long before the exit and what this means for operating partners and leadership teams. And Tony, welcome to the podcast.
Thank you very much, Ken, and thanks to you and Austin Lawrence Group for allowing me to come on and talk about a topic that is very near and dear to me. One of the unique things in my background is I actually used to teach private equity and venture capital finance at the university level. Actually do have students somewhere in the marketplace that are hopefully taking some of the first principles that we're going to discuss here today. So thank you very much. So to continue from my side, I started Lever6 about 3 years ago, and really my last real job was I ran a business unit for a publicly traded SaaS company called Workiva. I ran our integrated risk unit. My career has spanned management consulting. I've worked as a partner in a boutique investment banking firm. I worked in private equity, but also I've been fortunate to act as a operator for a number of companies, both privately held and again at the public level. And what I wanted to do was take my experience and basically say, hey, I want to get back to working with founders, business owners, early stage, lower middle market, and really take my expertise, but also create a advisory and investing model that basically combines a lot of different disciplines. So if you think about my background, being an operator, being an investor, or operating within a fund, I'm taking bits and pieces of all these items and putting them together. The core problem that I'm trying to solve within Lever6 is that if you look at the mathematics, roughly for every 100 companies that are what I call exitable or transferable or can transact, either going to private equity or a strategic buyer, or even just transferring hands to an internal management team, only about, I would say, 1 in 10 or maybe 1 in 5 actually will get that done and or will be happy with the process. So if you do that math, right, that's roughly 15, 20, 25%. It doesn't matter. That's a low number. If you think about it, you would think that the satisfaction and success rate would be substantially higher. So that is really the void that we are looking to fill. We do serve founders and business owners. We work with private equity firms. We work with family offices in various shapes or form. And we can talk about some of those particular opportunities as we go forward. But ultimately, at the end of the day, that's what we're here about, is basically finding companies, finding founder owners, finding the right investors, and moving them to their next stage of growth or development.
That's awesome. And I think what a resource for founders who it's very likely that they've never sold a company before and have no idea what that process might look like. So having an advisor with that kind of depth of experience makes a lot of sense. And maybe this is a great time to talk about some of the research that you do, that the reporting that you've provided us to look at as something that might be of interest.
Yeah. So if you think about my role, so people think about, and this is probably the kind of my foray in thinking about AI. So how we operate is, when I look at my background as an operator, and it's primarily been on the go-to-market side, like I said, I've been a COO and CFO. We're very partner ecosystem centric. So in other words, and I think from an operating partner model, we'll think about that's the best way to go versus actually owning your own resources. For example, right, if I need specific help on a go-to-market particular issue, do I use my own expertise or talent, or am I partnering up with somebody like an Austin Lawrence Group, as an example? But a couple areas that we've just launched, we've started kind of a market intelligence report for recurring revenue companies. You can go to my website. It's called the Compounding Report. There is just a lot of wealth in data within publicly traded companies for recurring revenue companies, which are not just only SaaS, right? We look at recurring revenue as an operating philosophy, meaning that you don't have to be just software or technology to develop a recurring revenue company, right? So this is it's a first principle and how you can create value around that discipline. Also, we just came out with our what we call our crucial conversations or exit conversations for founders. And this really gets into the nitty-gritty of why my company is going to sell for a certain range and why or why not. So it answers the question of, am I ready? Which is, for a founder or business owner, it's twofold. One is my company, the actual operating asset. Does it have the characteristics, the value creation characteristics that a buyer wants? And number two, am I personally ready? My spouse, my family, if those are part of the equation, the management team, both of those items have to be addressed first and foremost. Otherwise, you run the risk of a transaction not being completed, or, as I said before, a transaction may complete, but that process may end up being very unsatisfactory for the founder business owner.
I mean, there's a lot tied up in these companies where people might have spent 5, 10 years or more making them into something that they identify very closely with. So there's a lot to work through there. I think I'd love to dig into some of the topics we wanted to speak about today. And the first one was like right on the tail of this part of the convo. If exit planning should start years in advance, what can an advisor or an operating partner be pushing a portfolio CEO to put in place now?
Well, I'll start that kind of the highest level. And so people ask, where does lever 6 come from? And this is from my, high level, I'm big in the frameworks. You start in consulting, et cetera, you get the whole framework and methodology kind of first and foremost pounded into your head. So lever 6 really looks at 6 different areas that I indirectly, when I'm looking at a company, kind of figure out where they fit. So here are the 6 C's. First and foremost, culture. Number 2 is collaboration. How does the company work together as teams, but also how they are able to work together as teams with their partner ecosystem, suppliers, customers. Number 3, the customer themselves. Is the customer the North Star? What's the relationship between their processes and the customer? And then the last 3 are getting into what I call context, meaning that can the business operate around data? And ultimately, how do you make decisions around data or without data? Because ultimately, you are going to have to make decisions without necessarily perfect data. The other one is controls, right? Every business has to have some level of controls. You can call it governance, controls, et cetera. But the question is, does the organization have the right controls for their stage of development? Otherwise, it just becomes very bureaucratic and you just create a lot of overhead. And the last one is creativity. And this is what I call, this is the proxy for creativity. Has this organization have the capability or historical track record to build new products or new services in the marketplace? If you really look at a company and that they are doing all those things well, for the most part, everything will take care of itself. Does that make sense? I mean, literally, who doesn't want a company that has great culture, collaboration internally and with their external system, customers, the North Star, appropriate controls, can make decisions around data, and then certainly does have some processes or activities around innovation? I would think I would be a betting man over the long term. Those types of companies have the ability to create value. So when you think about from an operating partner perspective, and all these things, they're not independent. I mean, there are interdependencies between the 6. Some of them may or may not be more important depending over time. Also, every company is not going to score perfect or high in those areas. Those become the areas where you need to seek areas of improvement. I am a big proponent of culture will beat out strategy. When I started early in my career, the concept of the 90-day plan, 100-day plan, it's right up there with using the phrase synergy and all that stuff. It just kind of gets glossed over, right? And you do all these things and I want to optimize spend. And so you may want to look at, and early on days, people would just start laying people off within the first 90 to 100 days without even thinking about it. These days, I look at, we spent a lot of time on the culture side. Do I have the right people in the right seats in the bus? If you've read the book Good to Great by Jim Collins, it does work. So at the end of the day, you've got to get that culture thing nailed down. Number two is, and I would say alignment around the customer. Be a customer-led organization, and a lot of things will take care of itself.
Yeah, that's a very healthy approach to the private equity business. The business certainly has a mixed reputation. And it's great to hear you talk about things like culture and creativity as being a third of the important ingredients for the success of an organization. When a portfolio company is running well, but it wouldn't sell well, it sounds like they don't have all six of those C's operating. So, what is the first thing you'd have an operating partner do to try and fix that? Like, how would they approach that kind of problem where they're making their numbers, but they just don't look saleable?
This is an interesting dynamic, and we see this a lot. Once you look at the top level numbers and buyers, or you may have interested parties. So the question is, what is it that makes it not as attractive per se? One of the areas that if somebody's looking at the company, the concept of comparable peers. So that's probably one dynamic is, okay, yes, the company is at I'll just pick a number, 10 or 15% EBITDA. But when best in class companies are at 20, 25, or 30%, maybe double the rate, then you got to answer the question, right? So that is an example of, oh, this is a company that does have reasonable EBITDA, does have cash flow, is healthy, but it's not healthy in comparison to the peers, right? So the question is why? So it could be, is it overstaffing? Is it, depending on the company, it could be on the materials or the inputs to the business, which means maybe they're not pricing and packaging accordingly. So ultimately, there's going to be in that example, there's a margin issue that needs to be addressed, and then hopefully you're monitoring that ahead of time. But it's easier said than done. If you think about where the shift in AI or just shifting companies in general, think about companies that used to do business to business or starting to transact over the internet as an example. That shift over time created margin compression for a lot of firms, which they just weren't able to adjust. So it comes down to, is the business model in line with the market reality?
So there's a lot of context setting, I think, that has to happen here, right?
Correct.
You described a situation where, devoid of context, the company might look like it's doing okay financially and market performance, but once you benchmark it against its peers or the broader category it's in, SaaS category or information services category, you might turn up things that need to be addressed.
I would say in general, I think one company I used to work with, I'm not going to name them, but they had expectations of where they thought they would end up when they went to a secondary sale, and just the market shifted on them, and they couldn't get the product and growth rates. I mean, from a rule of 40 metric, just way off the charts. But again, for a lot of companies, if the value lever is growth and your relative growth rate is half of what comparable peers are, then you've got to really lean into that and try to understand the why.
Yeah, I also thought it was interesting you brought up pricing as an example in this situation. We've talked about pricing an awful lot in our business and on our other podcasts, SaaS Backwards. And my sense is that not enough, especially software companies, take a look at pricing on a regular basis. Do you see that same thing?
I do. And so if you think about, unless you've got the resources to hire Simon Kucher as an example, right, does a lot of pricing studies, it is definitely both art and science. When I was at Workiva, we actually had a dedicated team that did nothing but pricing and packaging, which was great, just how important it is. So, but unless you actually have a dedicated team and or dedicated resources coming in at the private equity firm level that's working with your firms, it is one of those things that can be there could be,
It's
money being left on the
underappreciated, I
table.
think. And one of the best things that ever happened to me when speaking with private equity guy, I asked him, how can we be more relevant to you as a private equity operating
Sure.
partner? And he said, well, tell me something I don't know, which, that's throwing the gauntlet down, I think. And hopefully, if he's listening to this episode of the podcast, he'll say, "Oh, pricing, boy, we haven't been looking at that enough." So I just think it's a really important, it's sort of it's the stepchild of a lot of leadership teams' planning cycles. It like seems to get pushed off. And just think it's so important.
Well, let me interject on that. And the reality is, my second favorite book, or one of my favorite books, is The Goal by Eli Goldratt, right? Which forces you into the framework, a theory of constraints. At any point in time, a business is going to have constraints, right? You can have this perfect scenario up. I want perfect pricing. I want the perfect product, which creates virality within the customer, referrals. You can go through the whole laundry list of this is where you want to get. It's just not going to happen. So ultimately, you're going to have to pick your poison, right? Pricing and packaging, yes, is an opportunity, but at the same, there may be constraints or downstream effects you have to deal with, right? So say, for example, I really want to go, I serve the enterprise and pricing and packaging. I want to take this current product and I want to go downstream with it. Well, okay. What are you going to do? Cannibalize your enterprise business? I'm just, pick up. Actually, that's a real scenario. Which
Either going up to enterprise or down from. Definitely hazardous territory.
Right. You just can't. Do you change the brand? Right. It's the same product. You can't take the same product and charge $100,000 and then charge $25,000. And then people charge, right? They'll say, why are you charging? It's the same thing. You're charging a different price. It just doesn't, it's not that simple.
Yeah. Packaging is definitely part of that equation, but I think it's an interesting lever that doesn't get pulled enough. I want to step to a different but related topic, which is deals don't always get done, right? There's a possibility of a deal dying before it gets to the table. And are there things that you see repeatedly that operating partners should be looking for in their portfolio companies? Like, what's the longitudinal contextual thing that you see repeatedly that might get in the way of getting a deal done?
So in the context of, from an operating partner, as we said before, as we were prepping for this episode, there's two ways to look at it. One is the operating partner in a situation where they are trying to acquire a new company that they're going to use as a platform. Or is this a situation where they already have an existing company? You're the operating partner that needs to work with it to get it repositioned for an exit. So I'll try to address both of those, but let's go with the former, which, as we said before, sourcing and acquiring new opportunities for a private equity firm is a talent and skill that differentiates the best from the others. It is a lot harder than it looks. And the reason why is, as a private equity firm, you're selling a commodity, right? It's capital. What am I selling? Capital. So why, if I have a great company as a business owner, why am I going to quote unquote sell or transfer to you? Got 1,000 people that can show up and do that. So let's think about in the situation where a deal may just die on the vine, so to speak. And one way to think about it is think about yourself as the buyer, the private equity firm. What is your goal? I mean, you want to buy the highest quality asset with the least amount of capital, right? You always hear hey, we really make our money on the buy side or the entry point. Or said another way, if you're going to pay a premium for a company, you've got to make sure that it's premium. And so you think about the issues where things kind of get murky because ultimately, since the private equity markets are so hot right now, what companies are paying to the relative quality is off. So in other words, you may have to be in a company that, I don't want to say that has hair on it, but maybe has some attributes that are not as perfect as you would like. Maybe the customer concentration is a little bit higher than you would like. Maybe the profit concentration is a little bit different than you would like. Maybe there's some seasonality that you need to kind of work through. Or also same thing from a customer concentration. It's not just at the revenue level, but maybe really peeling back the onion that your highest revenue customers are not necessarily the ones that are generating the most revenue. And that is actually a problem, right? Thinking about you could actually be more profitable by being rid of revenue, which is kind of throw things off. The depth of the management team, the founder and business owner dynamic is a tough one to get through. Particularly, the default is you want the founder and business owner to stay involved as long as possible because you just don't really know how much influence that business owner has with the customer and or the rest of the managers and key employees. Those are kind of the big ones that we see where things kind of really, if a deal is going to go waffly, and we try to uncover these things first and foremost up front.
I want to kind of tilt the conversation a little bit and talk about post close. So you
Yep.
get the deal done and you're having your first meetings with leadership as part of the portfolio. How do you suss out where the first moves should be? How do you get to the first levers of creating enterprise value in the new investment?
I do have a case study where the transitioning owner, co-owner, who ended up being the CEO for a private equity transition, ultimately, and I knew the CEO, and I would say I'd be shocked if you lasted a year, right? Because, and he lasted 1 month, meaning that there was just their operating styles were completely different. In fact, we are an investor in a firm that does nothing but identify communication and personality style conflicts and how people are wired for risk and decision making. So this comes down to early on is, do we really understand the marriage, the partnership, the governance and culture for the rest of the organization? So if you don't get that down early, it really just shortened the investment horizon of how much value you're going to be able to create. It's just going to be an uphill battle. So that's first and foremost is the culture, alignment of values, mission, vision, purpose, whether you use Scale Up or EOS or whatever framework. I'm completely agnostic, use them all, but you really need to go through that exercise and get that down pat if the founder, business owner is going to stay post-close working with the operating partner and the private equity firm, that stuff has got to get done.
Interesting that you mentioned EOS. Is that something or similar methods that you really recommend these firms, if they don't have them in place, get going with?
I do. Again, it's just a framework. It's a tool. Like I said, you can pick one, but ultimately this process of, does everybody understand who we are and what we're looking to accomplish? Just hardcore mission, vision, purpose, culture, values, those things do matter. They really do matter.
The last thing that we talked about in prep, and I think this was a fun one, you said that owners have what you described as a freedom number. And I'm wondering how you get that aligned with your target as an investor, your return targets as an investor. How do you get those CEOs who now work for you to stay aligned with a shared mission?
The freedom number, and again, this comes down to, and it's all subjective, right? And it is really problematic initially for founders and business owners when they're on the initial sell side. I'm not going to get into that, but that's what we work on. But even for the existing companies and management team, thinking about the wealth creation for the new CEO, which may be the business owner or maybe somebody that's being brought in from the outside to work with this business owner, or when the business owner transfers, ultimately there is a horizon that the private equity firm wants to operate. And then what is the CEO looking to accomplish, and getting those aligned in terms of the performance of the company and how value is going to transfer and getting allocated. There's no playbook for that. That is truly sitting down with people face to face and saying, okay, what are we trying to accomplish here? Do these set of incentives align with what you want to accomplish as a CEO within the time frame we need to operate? We just worked on a transaction that closed a couple of weeks ago. The CEO, co-advisor, he's going to come in as CEO. His time frame is 3 years. The time frame for the private equity buyer is 5, 7, or potentially can go into a quasi-permanent mode. So in his model, he's just there to help build the initial platform, get the companies integrated. But once they get up and going, he's going to be looking to find his successor. And that's completely different than somebody as a transferring second bite of the apple or new CEO that's thinking that they're going to stay for the life of the investment, which could be 5 to 7 years or longer.
Yeah, very different. I want to just circle back for listeners that have gone this far. You mentioned that you have two reports. I think we'll distribute them with the show notes as well. But can you
Sure.
just describe what, just high level, those two pieces of content so people know what to be looking for?
Yeah. So if you've seen it's what I call my market intelligence report, which is basically it will be a series of quarterly and interim reports, which is basically tracking the metrics and trends within recurring revenue companies at a public level, but also we're monitoring companies that we call quote unquote recurring revenue companies that are seed to Series C, as an example. Okay. We have some unique proprietary things that we're going to put into those newsletters. Actually, we have a big push on that. Actually, companies need to do a better job of describing what a recurring revenue company is at both the private and public level. So, what are the disclosures and reporting around what is a recurring revenue company? Because they are so valuable to both public investors and private investors. The other item is what we call our crucial conversations or exit conversations, which really gets down to both helping potential buyers and founders and business owners thinking about if what you need to do to really position yourself to transition your company or not.
That's great. And if people want to learn more about your company, Lever Six Capital, how can they do that? And how can they get in touch with you?
Sure. Find me on LinkedIn. They're fairly easy to find. You can also go to my website, lever6.com, and find me that way.
Awesome. And if people want to reach me, I'm on LinkedIn/in/Ken Lempit. My Substack is also really directed for the interest of private equity operating partners. You can find that on Substack. It's kenlempit.substack.com. And our advertising and strategy firm for SaaS companies, Austin Lawrence, is available at austinlawrence.com. And if Tony Rock hasn't convinced you that ProPEllant is the podcast for private equity partners and the companies that would like to sell, I don't know what we have to do, but we'll try again next time. Tony Rock, thanks so much for being here on the ProPEllant podcast.
Ken, again, thank you to you and Austin Lawrence Group for having me on your podcast. I look forward to the next one.
Thanks so much.